Hello again, clients and friends. It's Mark Masterson, Managing Director and Partner at Hightower, Naples, and this is our kickoff to 2018 Video Market Commentary. I have a great deal to share with you, and the first quarter commentary does tend to be a little longer than normal as I share our themes and our ideas for the coming year. So I'm glad you're here, and let's jump right in. My four horsemen remain positive. Keeping it simple and starting with the fundamentals as we always do, we expect growth to improve in 2018. We tend to be a little bit above consensus because as you can see, with tax reform being the catalyst, on top of the deregulation that the Trump team has done in the first part of 2017, we expect GDP to be in the mid-threes to maybe even as high as 4% in 2018. That's going to be a significant improvement, and that's why we've described it as being going from a bad economy to a less bad. We're going to be going from a 2%, which isn't horrible, but definitely below what we've come to expect in the U.S., to a more normalized 3.5% to 4%. Still not spectacular, but certainly less bad. Moving on to the technical picture and technical analysis, there's been no technical damage at all along this bull market run. I'm going to show you a little bit of that later. But the intermediate term technical view looks solid, even though in the short term we think that the technical picture might be a little bit overheated. We'll talk about that in a moment. And looking at sentiment over here, we're kind of in no man's land still, where the intermediate looks fine in terms of sentiment. There's a lot of apathy from investors and still a lot of concern, but the short term is a little overheated. So that's why we marked our sentiment as neutral, but our policy measures and metrics still look pretty bullish. We have global QE in place, primarily from the Japan and the ECB. You know, the Fed is raising rates. We only expect 2 rate hikes this year, which should be a non-event. And one of the risks is that the Fed does a little too much, but we don't expect that. And of course, as I mentioned earlier, the fiscal policy improvement with the tax reform is going to be a boost. So what we expect in 2018, we expect stocks and equities to deliver another positive year, a little more volatility this year. We're going to cover that. Fixed income, we're pretty neutral. Risks are to the downside. Commodities we think are going to start heading higher. Gold looks strong in the first quarter. We think the miners are going to be fine, and we are going to be looking to buy commodities. We think the dollar's in decline. We're going to cover that with elevated risk for a sharp move lower. And tactically, we've added Japan, financials, the gold miners, and our portfolios are reflecting all of the above, and we're going to cover it in great detail in the coming pages. Here you're going to see me depart from my usual format. Normally I cover the economy. I'm going to go straight into the equity markets because there's a lot more to say, and we think the equity markets present a pretty important opportunity here, far more than spending time on the economy. So suffice it to say for this video commentary that, again, we expect the economy and earnings to improve, and we think they're going to be a little bit above what the consensus is. So we'll leave that there, and let's jump right into equity markets. Let's take a quick look back at 2017. It was a fantastic year for stocks. In fact, the S&P 500 delivered a result that we haven't seen in 30 years. It was actually up every single month of the year. Pretty darn fantastic. We had a few clues in early 2017 that it was going to be a good year, and we shared them with clients in our meetings, our client meetings, our morning roundup that I send out each day, and these video commentaries. Let's take a look at one of those important clues. The S&P was never negative in the month of January last year, and that's kind of rare. And so I highlighted that, and I showed clients that in those few years where that took place, 2017 being one of them, since 1950, they tended to be a very low volatility year. In fact, I pointed out that the median was minus 2.9, so peak to trough drawdown of less than 3%. And that includes October of 1987, which had a huge decline. If you take that year out, it certainly would have been even less volatility. And so I point over here that, in fact, that did play out. We did have a very low volatility year in 2017. The peak to trough drawdown was only 3%. So that fact did happen to play out pretty well. And we point out down here that volatility, in fact, has remained very light. The major stock market indices have not been down more than 5% from a 52-week high in nearly 400 days. So again, we're kind of getting into rarefied air here. And there were only 3 other time periods that matched what we're seeing right now. And after each of them, the S&P declined more than 7% over a period of 30 to 40 days. So what's the lesson here? Volatility is going to pick up in 2018, in our view. Another clue that we highlighted in the first quarter of 2017 was this below, that when the S&P 500 was up, both in January and February, which it was in 2017, it has a fantastic track record of delivering good returns, positive results, but very good results. 27 for 27 since 1945. So again, we highlighted with clients that that bodes well, not just for a low volatility year, but as you can see, a positive year for the market. Of course, you don't know when you're in February what the year is going to look like, but the average return was 24%. In fact, the S&P delivered about 21, 22% last year. So this too played out very, very well for the entire year. And the final chart that we hit home hard last year, and still are for that matter, is this chart showing how bull markets end. And what you have here in this chart again is these are all of the bull markets going all the way back to 1937, and these are the years when they ended. These returns, 2 years and 1 year, the final 2 years and final 12 months of those bull markets, you can see the returns very, very strong. And again, we have averages, etc. down here. So the result here simply indicates the message, if you will, is you don't want to miss the end of a bull market. And again, we believe that we are in this phase, probably in this window here, where this bull market is going to deliver some pretty good returns, but we're going to see volatility increase along the way. So what clues are we looking for here in early 2018? Well, I've said it a few times. We expect volatility to rise this year. Why would we say that? Well, historically, as you can see, last year we had a peak intra-year drawdown of 3%. These are all of the low volatility years, anywhere from 3 to 6%, average of 4% down since 1945. And you can see in those years the market delivered good returns. However, the next year, following a low volatility year, we saw a pickup in volatility every single time. In other words, we can expect this year we're going to have a pickup in volatility. The message I'm trying to convey when I share this with clients is that it doesn't mean that the market's going to have a negative year. It does sometimes, like you saw here, but oftentimes you end up with a very solid return. You just have an increase in volatility, and that's what we expect this year. Here's another clue that we're looking at here early in the year. I shared it in this morning's roundup. 2018 is off to a great start. As you know, the holiday shortened first week of 2018 was a great start. The NASDAQ had its best start since 2004. The S&P 500's up 2.6% so far. And again, that's the best start of the year for the market since 2006. So far, so good. And here is the clue. Critically, as Ryan Dietrich noted, since 1950, when the first 5 days are up 2%, the S&P's higher 15 out of 15 times. Again, another perfect record with an average return, a solid return of 18.6%. So we're keeping an eye on that. And actually, as we have been watching the markets here today, it looks like we're going to hold that positive 2% plus for the first 5 days. So that's a good signal, a nice little clue to start the year. We'll also be watching how January ends, because a positive January has historically led to a positive year 86% of the time. Not bad, pretty solid probability. A down January has been kind of a 50-50 proposition. So we're going to be watching how the market progresses this month, but it's off to a great start. And again, volatility almost certainly will rise. But as volatility rises, I want to emphasize that it shouldn't be feared. In fact, volatility is very, very normal. This is a great chart. I've shown it many times, but it's important for all of us as investors to remember that even in great years, this chart shows the S&P 500, and these are some great years. There's always volatility intra-year. So for example, here's a year where the S&P's up 30%. Great year. There was a 6% drawdown in that particular year. How about this year? The S&P's up 23%, but there was a 28% drawdown. That would feel horrific here today, but we look back and you say, boy, what a great year. It's just easy to work your way through that. It's not. You have to expect volatility and know that even in good years, drawdowns are normal. You'll see two red arrows here, and I added these on purpose because just in studying the chart, I was taking a look at that and said, wow, so last year we know the volatility was low, 3%. Well, the last time that happened, as you can see it right here, is happened to be right at the end, or I should say right at the beginning of the end of the bull market in the 1990s. So you had a 3% very low drawdown, a great year for the market. The next 3 or 4 years were fantastic for the market, right? But volatility certainly picked up. And I think we may see that again as we move through the next couple years. This chart from Goldman Sachs highlights the prevailing wisdom out there that this bull market is in rare air. It's almost 9 years old. And again, that puts it in rare company. So if so, then this bull market is nearing the end. And again, wouldn't be uncommon to see fantastic results towards the end as the bull market comes to a conclusion. However, as many of you know, I've challenged that prevailing wisdom, and I asked the question, what if that wisdom is wrong? And this bull market is not 9 years old, but it's reset itself, not once, but twice. I know this chart's very, very busy. I'm not going to go through it in great detail, but I do highlight 2 places, here and here, where I believe the bull market reset itself, 2011, 2015, 16. I'd suggest that you pause this commentary and read the details here, but essentially, in this block of time, this window, the S&P fell 19.5%. Very close to the 20% bull market metric, certainly enough to scare investors. And here, it was just a disaster internally for the market. Obviously, the biggest decline was in oil, where it fell 76%. So take a look at those, pause this and read that and ask yourself, could it be that this bull market isn't 9 years old, but maybe it's 6 years old, maybe it's only 3 years old? These are definitely some things to consider. This chart by J.P. Morgan may be, in my opinion, the best evidence to the fact that the bull market reset itself. What you see in this chart is that investors are not pouring money into U.S. stocks. Certainly not at a pace that you would expect if the bull market was coming to an end. You see this column here that I've got highlighted in red. If this bull market started in 2009, you'd see record inflows as you got to the end here. Money be pouring in like crazy because that's what typically happens at the end of bull markets. And yet, what you see here is a very modest amount, 18 billion, 29 billion positive. Then a couple of negative years in that same window that I highlighted. And how about here in that 2015? Money left the equity market in the U.S. It didn't come in. These are paltry amounts of money coming in, very small amounts, certainly not indicative of a top or a bubble. We are seeing a little bit of flows into international. You see it here, 225 billion came in last year. That's great. Seeing an uptick there. But look at the bonds. I mean, this to me is more indicative of the end of a bull market. Come back to 2009, 300 billion, 200 billion, 100, 300, a little bit of an outflow, 80, 50, 220, 366 billion, 366 billion net inflows into taxable bonds strategies in 2017. And yet, with the S&P up about 20%, only 32 billion. So you have to ask yourself, does that look like a top or sound like a top? It does not. To me, it sounds like a market that has been reset a couple of times, and definitely some evidence that this bull market may not be 9 years old. And yet, I'll highlight here that, as I said earlier, short-term sentiment does look a little bit too hot. This chart suggests that the sentiment surveys that we are seeing are coming in a little too bullish. So the bullish sentiment's now near an extreme, bearish is low, and again, that would tell me that we're likely to see some volatility and have that reset itself with the markets correct a little bit over the coming weeks. But again, even though the short term is a little bullish, I'll tell you the intermediate sentiment is fairly neutral. This chart kind of shows you this, that investors came into 2018 the most bearish they've been since the financial crisis. 46% of investors were pessimistic about stocks heading into 2018. 68% think the market's overvalued. You can see that represented here. So as we come into 2018, even though investors haven't been flooding the market, they're getting more bearish. And again, this is another reason how the equity markets can climb the wall of worry. I love this chart. It basically highlights that even though folks are talking about this bull market and considering it somewhat historic, remember that 2000 through 2009, the first decade of the 2000s, was the worst decade for stocks in 109 years. And again, from that perspective, doesn't it make sense that we would have an extended bull market after the worst decade in 100 years? You can see it right here. 2000 through 2009 was negative, average a negative 3.4 essentially percent per year versus all the other decades. So I think that this actually scarred investors, that they've really not recovered and they've certainly not returned yet. I think we'll know it when they do. Thus far, our theme and this chart that I've shown a few times of highlighting the secular bull market and secular bear markets of the S&P 500, that pattern of a 15 to 20 year consolidation and then a 15 to 20 year rise seems to play out. So you have this long consolidation, then a rise, long consolidation where the markets go up and down but sideways, then a rise, another long consolidation, then another long rise, and then finally that consolidation that we saw in the markets from 2000 through 2015-16, and now we're rising again. And again, if this pattern does play out, then we have a fairly a good period ahead of us as a secular bull market unfolds. In this next chart, I just want to show you that within the S&P 500, this bull market channel is just marching on. It's been a nice steady picture there. And again, no technical damage, just seem to be working from the lower end of the channel back towards the upper end of the channel. Continuing the theme of a long base and then a breakout that we just looked at for the S&P, here we see the same thing. This is Japan. This is one of our tactical themes. And you can see here a great chart by Strategist that shows a 20-year base in Japan, the Nikkei, and now we're breaking out of that. And it looks very, very similar actually to the Dow here in the U.S. from 1964 to 83. A big 20-year base up and down and then a breakout. And as you know, if you remember that last chart in 1983 when that broke out, it really ran for years. So we may be seeing the same thing playing itself out in Japan. We're also seeing the pattern in other places. This is the NASDAQ. I showed you this chart before, but it certainly is justified looking at it again. Here we have a 16-year from the previous bubble high, the tech bubble, crashed, and then it really formed a long base, 16 years before it finally broke out. And again, in that theme of a large base and then a breakout, it does suggest that the NASDAQ may have a significant higher level to hit down the road. So we're positive on equities, as you can tell. We've got a number of different themes that we're highlighting there. Let's move on to bonds. But I will tell you, like the economy, I'm just not going to spend much time here in fixed income because we're underweight fixed income anyway. And while we hold bonds as part of our diversified portfolios, we just don't see too much in terms of opportunity here. So just one chart on bonds, and it's the one I've shown you before. We suggest that the bull market in bonds is just about over. We think there's some symmetry here between the last ending of the bull market and beginning of a rise in interest rates. So you get this bottoming process in rates, and then they head higher. Here we've had this long decline in rates, which is a bull market. We're in the bottoming process, and again, whether they head immediately higher or they just chop around and then head higher, we think that's where we are. And remember that on that chart I showed you before, where the money flowing into the bond market, it's hundreds of billions for the last 6-7 years flowing into the bond market here, and that's precisely the worst time to be loading up on bonds. You want to load up on bonds here and ride them down. Here's where you want to be trimming them back and looking for other opportunities. So again, that's it on bonds. Underweight. We'll hold on to some high quality conservative bonds, and that's about it. Let's move on to our final section here of opportunities we want to share with you, the real assets and currency markets. And we're going to start with the U.S. dollar. Longer term, this is our view. And again, we'll start with this because we think it's going to shape our views on a few of these other assets that we're going to share with you. But this is our big picture view of the dollar. We think we're heading lower here. You can see in the past, this is a 20-year view of the dollar. There were 3 peaks back here and then a big decline. We have 3 peaks here. We think we've started a big decline, and our view is we're going to end up down in this area in the next 12 months, maybe 24. But it's not a straight line. It never is. You can see even here there's bounces along the way, but we do think we're heading lower longer term for the dollar. This next chart shows our picture of what the dollar does during different presidencies. The red is a Republican president, and as you can see, the dollar has tended to head lower during Republican presidents, and again, we believe that we are starting that same trend here under the Trump presidency. This is a little shorter view of the dollar, not the 20-year, but the last few years, and we've highlighted this before, that the dollar has been trapped in a range. This is a big base. I think what we're looking at here is we're finally going to break down out of this base. We may have a little bounce in the short term because it is oversold on the dollar, but I think that the break, this support that has been a multi-year support, is finally going to break here, and the dollar is going to head lower. And again, that is confirmed by the dollar and the euro, which we've looked at before. Here we have the euro, and in the blue is the dollar. And historically, these two tend to pivot when you have these long periods of time when there's a gap with one rising and the other falling. They usually will return. And here we had this huge time frame here, multiple years, where the dollar was strong, the euro was weak, and we think they're now coming back together. So again, that would confirm our view that the dollar's going to be heading lower. So what does that mean? Well, what that means to us is the dollar, a weaker dollar, is going to be a tailwind for certain assets. And we think U.S. stocks will be one of those, but also commodities. And one of those is gold. So in this chart, I show you, again, the pivot points where as the dollar pivoted lower, gold rallied. Typically, these pivot points have proven pretty good. They don't always move inverse to each other, but they have. So if the dollar's heading lower, and we think it is over the next few months, and in fact, probably year and a half, then we think gold is going to work itself higher. And this is another view of gold through GLD, one of the ETFs that track gold. And again, so far so good. On our bottom call, we suggested back here when gold got oversold, got into our buy zone, that this area was going to be a good place to buy. And so far gold has had a pretty historic run, actually. It's getting a little bit overbought in the short term, and it may pause and pull back, and that may correspond with a little bit of a dollar bounce, which is perfectly fine. But we think that overall that this area is going to prove to have been a pretty good buying opportunity for this year. And in fact, when you look at the same chart, GLD, a different way, and you draw that channel, to us it makes great sense that gold's going to kind of chop around here and then work its way up towards the top of that channel where it may pause for a little bit. But so far so good on our gold position and the purchase that we did, the additional purchase that we did. And again, let me highlight a little bit about gold here, because oftentimes we have to tell clients why we hold gold. I like to share this chart because it does show, since 2003, just how well gold has performed, up about 10% a year on average. We all remember this window here. It's very fresh in our mind. It was a 3-year bear market for gold. That pullback was sharp and it hurt. But since then, gold's been up 9% and then 13%. And we just got to remember that gold is a solid diversifier. It's a great performer overall over time. It's a great hedge against volatility, which we expect to increase this year. It's also a good hedge against inflation, which we think is going to return in the coming years. And it's a great geopolitical hedge, which, again, in this environment seems to make a lot of sense. So we're going to continue to hold our gold position for clients. In addition to gold and silver, we have a position for clients in gold mining shares. We think they too will benefit from a weaker dollar. And this is a chart that just shows the index for miners, GDX, the larger miners. And what we like about it is, as you can see, this is a weekly chart. So all of these bars are weeks. And you can see this support has been tested now 4 times. So that tells me that with 4 tests of the weekly support, that support's probably going to hold, and we're going to work our way higher here in the coming weeks and months. And I also always like to remind clients what the opportunity is with miners. The gold mining bull markets can be pretty large. Each of these colors represents a different bull market run over a different time period, dating all the way back to the 1940s. But they range from 120 to 400 weeks long, and anywhere from 200 to 700% in terms of the magnitude of the rally. So you can see this black line, that's where we are on this bull market run. It's been pretty muted and not very long. So I don't think it's done. And if the dollar is going to head lower, then you can expect this rally to continue, which should deliver some pretty good gains. Not a huge position for our clients, but again, one that we think will be of great benefit here in 2018. The other opportunity and story that we're highlighting and watching for clients for 2018 and beyond is the commodity sector. Commodities do tend to benefit when the dollar's weak, and commodities have been one of those areas that has definitely been absent in this rally. In fact, you can see here, if you go back the last 6, commodities have been in the bottom, 1 or 2 performers in terms of asset classes for the last 6 out of the 7 last year. So that's very rare, by the way, to see an asset class live in the bottom area of performance. So it's highly likely that over the coming years, you're going to see a reversion where that starts to head higher. This chart by DoubleLine also shows us basically the same thing, where it shows that commodities are historically very underpriced to equities. And in fact, they haven't been cheaper in 45 years. So when you get to extremes like this, there's typically a reversion. And what we would expect out of something like this is commodities now to begin to outperform equities, not just for months, but for years. So if that's the case, what are we looking for? What are we waiting on? And I've shown this chart. We're really chomping at the bit because we do think it's a great opportunity, but we still have yet to really add to the broad commodity space because they too have been trading in a range. And for us, we really want to see them break out. We're getting close. We're back at the top end of the range, but we've been here before. So we're going to apply our discipline and we're going to wait and see. And we're going to see if commodities can actually break out of this trading range and finally start to head higher. And again, watching and waiting is probably prudent here because if we add on that breakout, after a 2+ year base, we really should see a strong multi-year rally. So that's what we're waiting for, and that's what we're looking for. And again, finally, the commodity space will really be a beneficiary from a weaker dollar. So they go hand in hand. That's why we covered it. So in summary, what to expect this year, 2018. Again, equities we think will deliver a positive year, but we're going to be at more volatility. It's just not going to be as easy of a ride, but we do think it's going to be a good year. Neutral on fixed income with risks to the downside. Commodities, gold, miners, and looking for our buy point in commodities because the dollar looks like it's in decline, with the risks being that it moves lower faster than people think. And again, our tactical additions include Japan, financials because of, again, rising interest rates in those miners. And our portfolios are already reflective of much of this. And if not yet, as we rebalance in the first quarter, they will be. So thank you. Thank you for your time. I know this went a little longer at 30 minutes, but I really had a lot to cover in terms of opportunities, and I hope it's been helpful to you. As always, reach out with questions, comments, or concerns, and I can be reached at this below phone number. You can call me anytime. And if you'd like to be added to the morning roundup, just go to our website and go ahead and sign up or send me a note, and I'll be happy to add you. Thank you again for your time, and I look forward to talking to you soon.